So good afternoon. So till now we discussed in the last three chapters we discussed what is foreign exchange market, the introduction part, as well as the foreign exchange exposure. So in this chapter, chapter number 4 is related to forecasting foreign exchange rate. Forecasting foreign exchange rate. What is the foreign exchange? As I said, a foreign exchange is nothing but the exchange of one country currency with another country currency. That is foreign exchange market or forex market we call it as. What is the foreign exchange rate? The rate at which the currency is exchanged. The rate at which the currency is exchanged. Take for example, what is the exchange rate of US dollars and Indian rupee? As per today's market, it might be around 89 or 88 rupees. That is 1 US dollar equals Indian rupee 89. That is the exchange rate. The exchange rate of US dollar is 89 rupees in Indian terms. That is the foreign exchange rate. So this chapter is related to the forecasting of foreign exchange rate. Why it is important? Why forecasting is important? What is forecasting? Forecasting is nothing but the determination or the estimation. Estimation of what? Estimation of future level of exchange rate. Over the period of time, what will be the exchange rate? Take for example, today the exchange rate is 89 rupees per $1. The next week, what is the exchange rate for next week or the next day or the next year or the next month? What will be the exchange rate? That is nothing but forecasting, determination or estimation, like we do in the forecasting of demand. What is meaning of forecasting of demand? Forecasting is demand means the future days what will be the demand for a particular product. In the same way, in a foreign exchange market, forecasting foreign exchange rate is nothing but we are estimating or we are determining what is the exchange rate over a period of time. What will be the exchange rate? Why it is important? Why forecasting is important in the international market? So forecasting helps the investors or the financial institutions or the business people or the anybody we can take who are dealing in the international borders or the cross border transaction or in the forex market. Anybody you take, the forecasting is very much important, because as an investor we think of making profit. Our ultimate aim is to make profit using some market or through selling currencies or the commodities or anything you can take, or import or export, whatever you do. The main intention is profit. So directly we can't make profit because we need to take the risk. Risk is nothing but the fear of loss. So to reduce the fear of loss, there are some hedging strategies. But exchange rate will fluctuate from minute to minute, second to second, or day to day. So that is why forecasting is important. If you forecast properly, or if you forecast perfectly, then obviously we can reduce the risk. Done. By forecasting, if you think in the next week or in the next day the price of dollars will go up, if that is the case, based on that we will decide whether we need to do the transaction or not, whether we need to import or not. Based on the forecasting, whether the currency is going to appreciate or depreciate or increase or decrease, based on that we are going to look for making the transaction. If you are facing loss, means if the currency is decreasing, means obviously we will not do the transaction. If the currency is increasing, means we will do the transaction because we will get more profit. So that is the ultimate aim of forecasting the foreign exchange rate. So in this chapter we have the international parity relation. So international parity relation is nothing but is also known as parity conditions. Here this international parity is nothing but the exchange of or the dealings between the countries. That is international parity relationship, how one country transaction is related to another country transaction in form of price levels or the exchange rate or the interest rate. So parity relation, international parity relation. International is nothing but the transaction between two countries. The parity relation is nothing but it is related to interest rate, exchange rate or the price levels. Done. And these theories help in determining the long-term fluctuation in these variables. In what variables? In interest rate or the exchange rate or the price levels. Done. What will help? The international parity relationship will help in determining the long-term fluctuation. The long-term fluctuation is nothing but over a period of time what will be the exchange rate, what will be the fluctuation, how much will increase, how much will decrease. Through international parity relationship we have certain theories in that. By using that theories we will determine what is the long-term fluctuation of exchange rate, price levels or the interest rate. So that is why international parity relationship is used. So in international parity relationship we have main three theories. One is triple P theory, that is purchasing power parity theory. Done. That is first one. The second one is interest rate parity. First one is purchasing power parity, the second one is the interest rate parity, and the third one is the Fisher effect. The one more name of Fisher effect is nothing but international Fisher effect. So in the international Fisher effect, that determine the nominal interest rate in the country is equal to the real interest rate plus the expected inflation rate. So the international Fisher effect, it determines that the nominal interest rate in the country is equal to the real interest rate plus the expected inflation rate. That is what the international Fisher effect says. So in this particular chapter we have problem related to international Fisher effect, where it is going to determine, it says that the nominal interest rate is equal to the real interest rate plus the inflation rate. Done. So that is what the international Fisher effect says. The very simple problems we can discuss. The problem number 1. So let us read the question. The spot rate. What is the spot rate? The immediate transaction rate. That is the spot rate. The spot rate of US dollar per Indian rupee is $1 equals 86 rupees. Done. For $1 we are paying 86 rupees. 3 months interest rate in India. After 3 months, the interest rate in India is 8%. Done. 3 months interest rate in US. The US interest rate is 5%. What is the expected 3 months forward rate in India? So they are asking what will be the forward rate after 3 months. So there is a particular question. They given what is the spot rate, what is the immediate transaction rate, that is a spot rate for $1, 86 rupees they have given, and they are telling 3 months interest rate is 8% and 3 months interest rate in US is 5%. We are going to calculate what is the forward rate in India after 3 months. So that is the question. So to calculate that we have the formula. So what is the formula? Formula is international Fisher effect equals 1 plus RH divided by 1 plus RF equals forward rate divided by spot rate. So what is RH? What is RF? So one is common in both the formulas. That is RH is nothing but that is the interest rate in domestic country. H is nothing but home country or the domestic country. RH is nothing but the interest rate in home country or domestic country. Done. RF is nothing but the interest rate in foreign country. That is RF and RH. Then FR is nothing but forward rate. SR is nothing but spot rate. Clear? So these are the aspects given, and we can write what are the given contents in the question. They are given what is spot rate. Spot rate is nothing but for $1 86 rupees. Rupees 86 is a spot rate. Then what is RH? RH is nothing but home country. Here they're told to calculate what is the expected 3 months forward rate in India. So India is a home country. That is RH equals how much percent? 8%. That is 0.08 or 8%. Then what is RF? RF is F is nothing but the foreign country. The interest rate in foreign country. Here the foreign country is USA, 5%, 0.05 or 5%. Done. If this is clear, then we can solve the problem in an easy way. First, write the formula. Formula is given 1 plus RH. What is RH? RH is nothing but 0.08 divided by 1 plus RF is nothing but 0.05 equals forward rate. We don't know the forward rate. Keep it as it is here. Forward rate we don't know. What is the forward rate. Here in the question, what is given? What is the expected 3 months forward rate in India? We need to calculate what is forward rate. So we don't know forward rate. Keep it as forward rate, or you can call it as X, no problem. Divided by spot rate. What is the spot rate? Spot rate is 86 rupees. Done. Now what we need to do? So what we need to do? We need to cross multiply this with this and the denominator with FR. That is a forward rate. Done. So before that, make a total of 1 plus 0.08, that is 1.08 divided by 1.05 equals forward rate divided by 86. Done. Now you make the cross multiply, that is 1.08 into 86 divided by forward rate 1.05, or you can call it as x into 0.05. Done. Or you can write it as you don't want to take it here directly. One is 1.08 into 86 and one more is 1.05 FR you can take, or F you can take, or also X is also fine. Now multiply 1.08 into 86. So if you multiply, we'll get 92.88 equals 1.05 FR. 92.88 or 1.05 FR. Now directly you can take it out. FR equals 92.88 divided by 1.05 equals how much we'll get? We'll get the 88.45 per dollar. So this rate is nothing but the forward rate. Therefore you can write it here. They are asked for what is the expected 3 months forward rate in India. We calculated what is the expected rate after 3 months. So therefore you can write the expected 3 months forward rate in India is 88.45 per $1. So this 86 is nothing but the spot rate. This 88.45 is nothing but the forward rate after 3 months. This is the forward rate in India. So very simple problem. Now we can go for the second question. It is also very simple question, just like your problem number 1. Read the question. Suppose in the July 1 year interest rate is 12% of British pound. It is British pound is a pound sterling. British pound is nothing but the UK currency, than 9% US dollars. So in UK the rate is 9%, sorry 12%. In US the rate is 9%. Done. If the current spot rate is 1.86 per 1 pound sterling, what is the expected future exchange rate? Whatever is given in the question, you write it. Write the formula and write the RH. What is RH? What is RH? RH is nothing but the rate, interest rate in home country. Interest rate in home country. So write the interest rate. Here they asked if the current spot rate is $1.86 per 1 pound. That means US is the home country because the terms are given in the US terms, so we can take it as RH is nothing but the interest rate in US is 9%, take it as 9%, and the RF, if US is a home country, then obviously the British pound or UK will be the foreign country, the rate at 12% or 0.12. Then spot rate is given $1.86, 1.86 per pound. Then write the forward rate is not given in the question, keep it as it is. We need to find what is the forward rate in the future. Then now directly the formula is there, write whatever the formula given, fill it. What is RH is nothing but 0.09 divided by 1 plus RF is nothing but 0.12 equals, we don't know the forward rate, keep it as it is. Then spot rate is there. What is the spot rate? Spot rate is 1.86 per 1 pound sterling. This is done. First you add it, 1.09 divided by 1.12 equals forward rate divided by spot rate 1.86. Then what we need to do, we need to cross multiply. First you multiply 1.09 into 1.86 equals 1.12 forward rate. If you multiply 1.09 into 1.86, we will get 2.02 equals 1.12 forward rate. By now directly we can write forward rate equals 2.02 divided by 1.12. Ultimately the forward rate will be $1.80 per 1 pound. You can take two digits or 3 digits. You can take 2 or 3 digits. That is, you can take 2.027 something. You can take whatever you multiply. Take 2 to 3 digits. Done. If you divide, you will get $1.80 per pound. Now we can write therefore after the, so they didn't ask for the number of months. You can take it as, you can write it as it is. If number of months is given in the previous problem, they told what is the expected 3 months forward rate. For 3 months, after 3 months what will be the rate, we used to calculate, but here the number of months is not given, take it as it is. Therefore the forward rate is $1.80 per 1 pound sterling. Directly you can mention it. Thank you.